Welcome to the Lend Academy podcast, session number 29. This is your host, Peter Renton, founder of Lend Academy. Today on the show, I'm delighted to welcome Scott Langmack. Now, Scott is a name newer investors might not recognize, but back in 2009, he was instrumental in bringing many new investors to Lending Club. He helped spread the word and helped create sort of a system of best practices for investors. When I first got involved in this industry, the series of webinars that Scott Langmack helped do for Lending Club were instrumental in really helping me get educated about the space. When I first discovered them, I felt like it was a gold mine. I watched all of these webinars over the course of a couple of days. And I wanted to get Scott on this show because he is one person that's really seen Lending Club evolve from those very early days through to today. We met up at the Lending Club IPO last week in New York. He agreed to come on the show and share his thoughts about really the evolution of Lending Club and also where it's going. Hope you enjoy the show. Welcome to the podcast, Scott.
Thank you, Peter.
Okay, so I know your name may not be as familiar to many of the listeners, so can you give us a little bit of background about yourself and how you came to find out about P2P lending and Lending Club?
Well, yeah, so I am a background of marketing and technology. I was the head of worldwide marketing at Pepsi and then had some divisions at Microsoft, did marketing for. Came down to Silicon Valley and was doing startups in Silicon Valley. One of my startups was a jobs recruiting-oriented tech company, and I was helping in the summer of 2007, helping Renault look for VPs of marketing. And that's when I first came across Renault in their very, very beginning.
How did you meet him?
We had a mutual friend who made the introduction, knew I had my company, and he had a need, so...
Okay, so then at that time, was this pre-launch for Lending Club? Where were they at?
Yeah, this was right as they were getting ready to do their first rollout on Facebook.
Okay.
You might know that history, but that was their very first effort was to get out on Facebook before they sort of evolved to the model that was more classic web. So then I really got started on this whole space when I bumped into Renault about a year later, September 2008, and asked him how things were going, and he showed me his business model and his business deck, more from a investor perspective. And it was the kind of thing where I thought it was too good to be true, so I studied the market, studied things all around credit, and tried to understand why it could possibly make sense. In the fall of 2008. Lehman Brothers had gone down. The financial crisis was in full swing. Bernie Madoff was out there. The conventional wisdom was anything 10%, and is going to be risky. Prosper had been for the most part, was getting a bad rep on the number of losses they were generating, and so all that was swirling as Renault was trying to generate a little more investment in both the platform and then in equity.
Right, because I guess back then, the real challenge for Lending Club was the investor side of the business. They could find the borrowers, but getting people, particularly I imagine in the fall of 2008, getting people to come on board as an investor would have been their major challenge. So by that stage, were you already an investor on the platform, or did you start right around then?
Well, yeah, so I had, in summer of 2007, put up a very small account, but I hadn't paid a lot of attention to it. I was mostly doing it out of curiosity. And then in 2008, when I dug in deep with him and looked at the opportunity of investing more in both places, equity and platform, then that's when I dove in, very deeply. And for me, there's three main points that I kept digging on, which essentially defines the reason why the industry is interesting, right? So the one that I first became very surprised to learn is that the top credit-rated people rarely default, even in recessions. Their default rates, they'd do almost anything in the world possible to avoid a default, and hence the predictability of those returns. And then understanding the difference between lending to a friend and lending to a bank, because we're all raised by being taught neither a borrower nor lender be, mainly because you borrow or lend to friends. And when a friend borrows money from you, he thinks you have extra money. That's why he asked you. When you lend him the money, you prove to him you did have extra money. And then when he wants the money back, he wonders why you want it because it was extra. What's the big deal?
Right.
Where the opposite is that banks will ruin your life and your credit and make it very difficult to function in the world if you don't make your payments back.
Mm-hmm.
So that was the next big aha. And then the last one for me that really got me comfortable with the idea of investing was the idea of the backup processors, because Silicon Valley is notorious, of course, for startups that get going and then don't make it. And if you're in the middle of a 3-year loan, then what happens? So understanding that there's a whole industry of backup processing for loan generators, and it's a pretty standard process, was, for me, the 3 pieces that I thought were smart enough to get me to jump on the platform and on the equity side.
Right. So, yeah, you became an investor back then. I mean, we were both at the New York Stock Exchange last week and, heard Jeff Crow talk about the dark days of 2008 when Renault basically went along. Obviously Jeff Crow of Norwest and Dan Cyprian of Canaan Partners were the 2 leads in the first Series A. And basically Lending Club had to go through this SEC registration, which is extraordinarily expensive, which wasn't really planned, and they were running out of money. And, I remember, what Jeff Crow was basically saying was that, despite the fact, Renault never wavered in his confidence, and obviously they decided to basically re-up and invest again. And was that the round that you invested equity in as well?
Yeah, I was alongside that round in October 2008. Okay. And so the basic deal for me then is that's when I started putting my first $1 million on the platform. Mm-hmm. So I was one of the first ones to put that kind of scale. I wasn't the first. There's at least one other person, maybe 2 ahead of me with that kind of scale. But going in with that scale, which is nothing now, of course, but at the time it was quite a bit. And so for me, I did that, both equity and the platform, for 2 reasons. One is my background was marketing. Renault did not have a senior marketing person on the staff. We never were successful helping him find one in 2007. Mm-hmm. And so I just said, hey, I know how to grow your business. Here's a whole bunch of concepts that we can work on. And if these make sense to you, then I'm in on both the equity and the platform. So that then led me to come on as a kind of a contract person, consultant. I came in the office every day, worked with the team, had my scott@lendingclub.com email, and, went through the whole song and dance of the different, messaging referral programs and trying to understand what were those key factors people needed to know in order to be confident that they could invest in this crazy time period of 2008, 2009, which seemed so risky and felt risky in every way to people. Right.
So you came on board purely to try and you were focused on the investor side instead of the borrower side. Is that correct? Were you completely focused on the investor side?
That was where my energy went. It wasn't as hard to find people who needed to borrow for the platform at the time. Mm-hmm. The big challenge, the biggest challenge by far at the time was getting investors on the platform. So that was where all my energy went to. And it was an interesting time period because this was so early in the age of P2P that the things we take for granted as obvious now weren't there. So, for example, the most obvious one was diversification. One of the biggest problems that was happening to Lending Club, as did Prosper, was people would put a lot of money on 1 or 2 loans, and one of them goes down, and then they lose a lot of money, and there's no recovery. So, as we looked at the statistics of it all, at least 100 notes were really important, but ideally you would go to 350 or 400, and even better to 1,000, of course. So if you run all the statistics on it. And so I talked to Renault about these things that were seemingly essential to get lenders on board. I said, look, we've got to figure out a way to tell people about the stability of the industry, about the nature of FICO scores and why top-rated credit people aren't that risky, about how to invest on the platform for diversification, how to understand what's happening on the platform when it comes to charge-offs. Because a lot of people would get on the platform, think they're going to earn 15%, and then they start to see charge-offs and panic. And all those sort of fundamentals were not communicated.
Right. As I mentioned in my introduction to the podcast, you then you created these webinars, which, I went and watched, I think all of them when, back in 2010 when I first started going. And it was really the only educational piece that I could find online back then that showed investors, really best practices and how to do this. It was a fantastic service. So can you just tell us a little bit about the webinars and what their purpose was and how successful they were?
Yeah, so Renault was at a very tough time, having finished his SEC approval, now being allowed to bring on new investors. The rules were very tight, regulations were very tight around what he could and couldn't tell investors about how to work on his platform. So he really believed that he was not able, on the Lending Club site, to give any kind of advice at all around diversification, what to expect, or understanding why top credit rated people aren't as risky as it might seem. And so, because I wasn't an official employee of Lending Club, I volunteered to do this series that was essentially the result of all this analysis I was putting together to say, here are the fundamentals. And so it was a combination of the fundamentals of why the industry is okay and makes sense, and then why or how to actually work best on the platform to minimize your risk. And at the time, particularly, we talked about beating the average because the underwriting wasn't quite as polished as it is today. And there were tricks people could do, or techniques, tricks isn't the right word, but techniques and approaches people could use to just hedge their bet a little bit better. So I volunteered to do these webinars, and so then Patrick Gannon and I would set up every other month a different webinar. Patrick would ask questions. I would go through the PowerPoints. They made sure that it wasn't a Lending Club person giving any advice. I gave lots of advice. Mm-hmm. Yeah, so it was good fun.
So what was some of the things that you I know it was a few years ago now, but what are some of the things that you shared to investors back there about how, like, best practices?
Well, in best practices on the platform, this was, really simple stuff. So it has to do with diversification, and I tried to consumerize it. So in the webinar, I had little visuals that would show if you have 100 peas in a bowl and you picked 5 out, one of those 5 could be a bad pea if you couldn't tell. But if you had 100 peas in the bowl and there were only 5 bad ones in the bowl, then you took all 100 peas, and your chance of getting a bad loan, essentially, via the P, is going to be statistically at the average by definition, because that's what the statistics would show, and that would be your ability to control and predict your returns by predicting your charge-off rates. So I had some very simple charts. I went through page by page, trying to help people understand what statistics means and why it makes sense for diversification, because that, above everything, was the most important thing for people to understand.
Sure, that's still the most important thing.
Yeah, and then I went through the other most common reason charge-offs happen is unemployment, and since I happen to come from the industry of jobs and job finding technologies, I understood that space pretty well. So I had a fairly good sector on how do you look at someone's profile and bet on whether they're going to be a well-employed person, or if they lose their job, how might they be reemployed. So, that was another key one. And then one of my other ones I spent a lot of time on was the default curve, because there was a dynamic on the platform where we're all familiar now as participants in this space. But, the first 2 or 3 months, you think you're a genius investor because your 13% notes are returning 13%. And then by month 5, 6, 7, 8, 9, every month you're going down on a pretty steep slide. And nobody, there's no way to know, if you're a consumer, that slide is going to bottom out at 4 or 5% and edge back, so that by the time your loans mature, you get your 9 or 10% return. There's no way to know that unless you are explained this dynamic of the default curve and how the charge-offs are virtually always accelerated into the first 12 to 15 months. So I would spend a fair amount of time on that. And that was important because at the time, what was happening on the platform was right at that moment where someone, let's say 4, 6, 8 months in, should be recommending it to their friends, they were panicking and pulling money off the platform. Right. And then right at that same moment where they should be doubling down and quadrupling or quintupling whatever their total investment, they were just holding and then wait and see. And it really slowed the whole natural viral dynamic down a lot. because of that uncertainty.
Mm-hmm. Mm-hmm. So how did these webinars go for Lending Club? Did it help? It'll help attract investors?
Yeah. No, Lending Club asked me to keep doing them. That's one reason. But no, we were measuring very carefully. They had a pretty solid team there. Rob Garcia on the product side and Sol Hittite on the tech side, of course, the early guys, and then Sam Castle was there. But everybody was curious to see what was happening from these, and they were able to track who was on the webinar and then who went directly to the site and who would put money on. And, we'd have as many as, I think our highest one was about 950 people per webinar. So the attendance was good, the conversion was good, and it was great. So for most of 2009, every other month or so, we would put on a new one. We did one in particular about IRAs, which I still believe anybody listening, your IRA should be in P2P. It's the best possible place on the planet for an IRA. The compound interest is magic. Mm-hmm. And then we did other ones more focused on kind of advanced investing and understanding the default curve. What do you do about it, and how would you manage that? And so, depending on the different topics that were interesting and that were coming into Lending Club, I would design a webinar around that, and then come in and do it.
Right. It's a shame those aren't available anymore. I mean, they were. I actually didn't watch these webinars live. By the time I really got involved, they had been archived off, but they were still available on Lending Club's website. And I remember watching over the course of a couple of days, several years ago, watching all of them and just thinking how I thought that was such a great resource. And it's a shame they've been taken down now. But I think that the principles you talked about back in 2009 are still very much in play today. So I want to switch gears a little bit, talk about your fund, because a lot of people think that, LC Advisors was the first fund or Colchis was the first fund in the external fund in the space. But, neither of those two entities were the first. Your fund was the first. And so
it's funny. I've been a little bit quiet on the background because I have private investors that fund us. We don't pitch for money. Mm-hmm. And so I'm not out sort of sending out all the marketing material. But as soon as I did my first webinar, then Renault started asking me in early 2009 to put a fund together. And I thought, well, it would be quite a risk because the whole category wasn't even $100 million. And anybody who starts a fund knows the fees are so small in something like this that you've got to actually get to some pretty significant scale in order to even make it worthwhile to do a fund. But I decided to go ahead and do it at his request in order to just start putting down a track record. Because every friend I had in the finance world would say that when you get a 3 or 4 year track record, you're golden in the investment space. So I went through the whole RIA process, got the fund up and going in October 2009. It was a month or two before LC Advisors started. And for the first year or so, the way that we were working with Lending Club was I was doing a managed fund, trying to optimize the return, and LC Advisors was essentially doing their index on their main part, and then they did an AB option on their fund as well after that came out. So between the money I initially put on the platform, which I call my pre-fund investment to start the track record, we have, 5+ years of the full fund working on our track record, and we have 6 years if you include the pre-fund money on starting in early 2008 or late 2008. And so that's been the longest running. When Colchis came out about a year and a half after we did, some friends started showing me the marketing materials that they were seeing. And of course, they just started on Prosper. They weren't on Lending Club for quite a while, actually. Mm-hmm. But that's the timing in our fund.
So can you share some of the returns or any information about the fund with listeners?
Well, so our core fund is very interesting because it's basically a 9.3% return to investors every year in, year out through 2009, 10, 11, 12, 9.3 plus or minus 20 basis points or so, but not much fluctuation. It's been steady as a rock. And so that part has been pretty fascinating to see, and an outstanding, I think, counterpoint to all the naysayers who are talking and maybe less knowledgeably about the P2P space, about what a big risk it is for a downturn in the market to get into P2P. We saw zero hit to our returns through the entire worst part of the recession. And that was partly because Renault was adjusting interest rates up to compensate for a slightly higher charge-off rate. But it was all managed pretty darn smoothly, watching where the trends were going.
Right. I know you don't do the day-to-day management for this fund, but you have a fund manager. Are you still doing active? Like, are you trying to still cherry picking loans? How are you? Has the investment strategy changed at all?
Well, my investment management team is doing what everybody's doing now, which is you do constant analysis on what's on the platform and all the data, because of the data transparency, and tweak the models a little bit. But for anybody who knows the credit team and the credit people at Lending Club, that there is a little bit of futility in all that analysis and looking forward, because they're adjusting their own price models every quarter. So no matter what you do looking backward, you think you're applying it today, you're fooling yourself. The other dynamic is that they're getting better and better at their own pricing. Of course, that's the nature of their business. And as you and I have talked, Peter, the game in this space now is not really as much about how carefully do you pick the loan, but it's getting the right volume at the right grades.
Mm-hmm. Yep, for sure. Okay, I want to now bring us into the present. And talking about what you're doing now, I know you mentioned Sol Hittite, one of the very early people at Lending Club, and he has since left Lending Club and is now creating a P2P lending company in China, Dianrong or Sino Lending. I know you were instrumental in helping that get off the ground. Can you share what your relationship is with Sol and what you did to get that platform going?
Yeah, no, that was it's a fun story. So, in those early days, there was, 10 or 12 people in the office. So we all got to know each other pretty well. John Donovan, Sol Hittite, Howard Solovey, John Stewart, Chris Young, that whole, gang. And so as Lending Club's been growing, when I walk through the Lending Club hallways, I know fewer and fewer people, but one day I'm at Lending Club visiting, and Sol's in the hallway, and he says, "Scott, I've got something to show you." And so he reviews his idea for starting a P2P in China, essentially Lending Club China. And, I thought, wow, this is completely crazy. But if he's got enough guts to do it, maybe I will get involved. And so I helped him through his process of getting his business plan together and get his angel investment group together. So I was his lead angel on that, and helped him get that first round of financing done. And I work with him pretty closely as close as you can when he's in Shanghai and I'm out here. On his board of directors, and we spend a moderate amount of time just making sure that I can help him however I can. He's pretty magical. That Dianrong, as it's pronounced, Sino Lending, as we've been referring to it, has been just stunning in its pace of growth and the amount of traction it has right now, getting top tier finance companies in China behind it, and some really big markers going down, positioning Sol as one of the fintech leaders of China.
Mm-hmm. Mm-hmm. Great. So beyond Dianrong, and you have your incline fund, and I believe there's a new incline fund coming out. Is that the extent of your involvement in this industry today? I mean, are you working with any other platforms, or what are you doing in the industry today?
So the fund that I'm, I guess what would I call it, a significant owner in. I call myself chairman because the investment team actually hired Howard Solovey, the first CFO of Lending Club, to run it. So he's quite expert at everything related to this. But we've launched a leverage fund about a year ago, and now rolling into other platforms beyond Lending Club. So that group, the investment team, is managing it well. I have there's this very interesting friendship of the people that were in the early days at Lending Club, and including the early engineers. There's Visar Nimani and a whole group of people, Leonid and Paresh and the gang. And so this group is off thinking about what's next in their world of P2P, and so I can't reveal anything. But
Okay.
we are doing more angel investing, and there are more things happening.
Right. Okay. So I can't let you go without talking about the IPO that we were both present at the New York Stock Exchange last week. Obviously, it's been personally, financially for you, it's been a huge success. You taking a punt back in 2008, which seems obvious in hindsight, but I know at the time it must have been, it must have felt like it was a bit of a gamble. So just tell me your thoughts, having watched this company now really since its inception. What was your thoughts on IPO day last week?
Well, IPO day was, to me, two very clear thoughts. So there was there's a team of people in any startup that need to work in a certain way of inventiveness and creativity to get it off the ground and get it going. And so the group that I was more connected to was that very early group. And just as we all know, once a company gets to be a certain size, then there's a different kind of professional, the more seasoned, operating-oriented, large company skill set people. And it was pretty fascinating just to sort of stand back and look at the team of the startup guys who got it, essentially to about $1 billion valuation as that transition then rolled over to the team that took it the rest of the way. Shouldn't say $1 billion. Kerry and Scott, of course, were a big part, and that the company didn't have nearly that valuation when Kerry and Scott got there. So, but the transition, just the whole dynamic of watching the beauty of startup then evolves to larger operating organization, and then the IPO, clearly all about the future. Here's a team that's going to take this thing from $8+ billion market cap to hopefully to 20, 30, 40 billion, right? That's
Sure.
the bigness.
Sure. So have you sold your shares? Are you still a Lending Club shareholder?
I've sold a very few of my original shares. Yeah, no, I'm a believer. I'm a believer in the next 2 to 4 years in particular. I think we're going to look back in 2 to 4 years and say, wow, it was so small and young back then. So, I think there's tremendous opportunity, especially for Lending Club and a few others that have scale and have momentum.
Okay, so last question then. So where do you see the major opportunity for Lending Club over the next 2 to 4 years?
Well, that's really going to be a tricky one, right? The question is going to be how broadly can they go beyond the core that they have been in of straight unsecured loans? Are they going to go into asset-backed lending or small business lending? Do they need to go into more spaces? Is really a big question. There's no right answer, I think. I think they could grow in any of those directions aggressively. One has to, I have no inside information. I'm not connected with anybody about these things, but my guess is that with that kind of cash in the bank, they might also be looking at acquisitions in order to help enter new spaces and gain scale more quickly. So that's what I would be looking for.
Okay, well, on that note, we'll have to close. But I certainly appreciate you coming on the show today, Scott. It was fascinating to hear what it was like back in those early days.
Thanks very much, Peter. It's been great talking to you.
Okay, see ya.
Okay, take care.
I can't imagine what it was like making a decision to invest in Lending Club back in the dark days of 2008 when, let's face it, we didn't know what was going to happen. Was the entire banking system going to collapse? Were we going to have another Great Depression? We didn't know what was really going to happen. And I think it was fascinating to find out some of Scott's thoughts from back then about, why he invested and the fact that he was willing to put $1 million onto the platform to invest in loans, again, not knowing is unemployment going to go to 25%. We really didn't know that back then. So I thought that was fascinating. And now even looking, that was just over 5 years ago, and you look forward to the next 5 years, and certainly the opportunity is great for this industry. So on that note, I will sign off. I would like to wish you all happy holidays, Merry Christmas, enjoy your break, and we will be back better than ever in the new year. Thanks for listening. Bye.